In today's video, we're diving into a fresh take from one of Wall Street's most well-known voices, Tom Lee, co-founder of 𝗗𝗟𝗏𝗧. He just appeared on CNBC's Squawk Box and shared some bold insights about what Bitcoin might be signaling for the broader stock market. According to Tom, Bitcoin is telling us the S&P should recover in the near term. That's a big statement, and it could mean we're at the edge of a major turnaround, not just for crypto, but for the entire tech sector and beyond. In just a moment, I'm going to show you that clip from CNBC so you can hear exactly what he said. Then I'll break it down with my own thoughts. No fluff, just straight analysis. After that, I'll walk you through what I believe is the best high-growth tech stock to buy right now. This stock has major upside potential and could set you up nicely for life before the rest of the market catches on. So if you only watch one video today, make sure it's this one and stick around till the end. You do not want to miss what's coming. Hit that like button. Let's aim for 1,000 likes on this one. Share this video with anyone who's serious about investing, drop your thoughts in the comments, and of course, subscribe to the channel so you never miss a key update that could move your portfolio. Now let's hear what Tom Lee has to say.
Investors are getting set for this week's Fed decision. Joining us now, Tom Lee, Fundstrat Global Advisors, head of research. And a lot of, again, Tom, I don't know how you would characterize initially your take. Maybe a little bit early on the stabilization, but then you really pretty much nailed it a couple of weeks ago, and that was the low. You said 5,500 near term on the S&P. We got to that easily. Can you summarize what you've seen the past couple of weeks and what you think happened? I guess the peak tariff angst was hit when you said it was hit, and couldn't it come back still though?
Joe, I do think tariff fears can come back, but the stock market and I think the macro is in a better place today than it was on April 7th. One is I think that the tariff expectations, even if we don't know what they end up looking like, are really much better than what we saw on April 2nd. The second is that the markets that lead stocks, such as credit and the VIX and high yield, are in a much better place. High yield has recovered almost all the widening that happened since April 7th, and the VIX is uninverting the term structure, which basically means the market for volatility is calming down. And then I think when we look at 2026, I think there is stuff to have some confidence about because the economy is holding up better at the moment, and next year we can look forward to deregulation. I think the comparisons for earnings will be much better for next year. And then, of course, if we get some tariff policies that lead to exports, we have upside to earnings growth. So all in all, I think it makes sense that the markets have recovered to this point. But, the bar for recovering to all-time highs is, of course, higher. But I do think the risk-reward is actually still positive here.
Yeah, I was thinking that, too, that you're probably thankful and gratified that we're back to where we are, but just seems like there's some backing and filling that's going to be happening before we break out to new all-time highs. Do you think with the tariff regime as it is, some of the comments made by President Trump over the weekend that why would, if these are temporary, why would anyone build a plant here? So that some of them might be permanent. I still think it's negotiating. I'm still not sure I take that at face value. But if it's a permanent regime of tariffs, you still think we get to new highs in 2025 or by 2026?
Yes, I think new highs are possible this year. I mean, one reason is, companies have proven themselves to manage through shocks, and I don't think investors give them enough credit. That happened with COVID. Companies survived. Companies survived a bullwhip effect on the economy. They survived a surge in inflation. They survived the Fed hiking at the fastest rate ever. So I think this tariff shock, while it is shocking, I think earnings will probably outperform expectations. I mean, that'd be one thing. And then I think the things that were leading us down, whether it's Tesla or the Mag 7 or Bitcoin, they've begun to recover. In fact, as you know, Bitcoin's above its April 2nd level. So Bitcoin, I think, is telling us the S&P should recover towards the 5,800 level in the near term, and that's still upside from here.
Yeah, that was another one of your calls that it would catch up with gold, and it's lagged in the past. What about some of your good calls or accurate calls, Tom, have been based on inflation. And it's a real sort of a push and pull between what we're worried about with tariffs, which would theoretically, restart inflation, even if I don't know if restart's the right word. Maybe there is some still left in the pipeline. But oil, I just always think that the most important factor in inflation, which ripples through everything, is oil. And you look at oil, and I think that could counteract a lot of what we see from, maybe even not only offset the tariff inflation, but actually be more important. So what's the Fed do?
Well, I agree with you, Joe. I mean, the two leading indicators for inflation should be, like you said, commodities, and oil is telling us inflation is weaker. And the labor market, the JOLTS data shows the job market's not that strong, so there's not really a wage pushing inflation. And I think the inflation data recently shows inflation is tracking lower than expected. The Fed has been on hold, and they're saying they're waiting for tariffs. But what's interesting is the ECB has been cutting rates, even though there's tariffs, inflation hitting Europe, or soon to hit Europe. The reason is ECB's inflation measure, the HICP, exclude shelter. If the Fed excluded shelter from its core inflation calculation, it's lower than Europe now, and yet Fed funds is over 225 basis points tighter than Europe. So I can actually sympathize with the argument the Fed should be cutting now, even if we don't know the effects of the tariffs.
Tom Lee is known for going against the grain, but more often than not, he's right on the money. And in this interview, he dropped some key signals that a lot of investors might overlook if they're just casually following the headlines. So let's start with the core of what he said. Tom opened up by talking about the market stabilizing after a rough patch driven by tariff fears and geopolitical uncertainty. He acknowledged that while those fears might resurface, especially with trade policy still being unpredictable, the overall macro picture has actually improved a lot since early April. Here's the key. He pointed out that leading indicators of market stress, like the credit markets, high-yield spreads, and the VIX, volatility index, have all calmed down, and that matters. Because when credit tightens or volatility spikes, that's usually a sign of deeper trouble ahead. But now, the VIX term structure is inverting, a classic sign that markets are stabilizing and fear is dissipating. Plus, high-yield credit markets, which are often the canary in the coal mine, have almost fully recovered from the recent widening. That's not something you see in a bearish market. Tom also talked about the outlook for 2026, and this is where it gets really interesting. He said the economy is holding up better than people think right now, and that's a strong counter to all the doom and gloom headlines. According to him, we could see a few tailwinds coming into play in the next year or two, things like deregulation, better earnings comparisons as the economy normalizes, and, if tariff negotiations go the right way, even a boost in exports. All of these factors could drive earnings growth, and when you combine that with calming markets, it sets the stage for a potential run-up, maybe even to all-time highs again. Not immediately, of course, but he believes the risk-reward is still positive, which is crucial for investor sentiment. Now, Tom was challenged on whether we're heading into a permanent tariff regime, and whether that would hold the market back. His response? He doesn't think it would. Why? Because companies have already proven they can manage through massive external shocks. COVID, inflation, supply chain chaos, and the most aggressive Fed rate hike cycle in decades. Yet here we are, and many of those companies are still standing strong, some even thriving. His take? If we survived all that, this tariff wave, while disruptive, isn't enough to derail the long-term market recovery. And here comes the part that really caught my attention, and probably yours too, Bitcoin. Tom Lee says Bitcoin is sending a clear signal that the S&P 500 should recover in the near term, potentially heading toward the 5,800 level. That's a bold call. But here's why it makes sense. Historically, Bitcoin has acted as a leading risk-on asset. It tends to react earlier than equities to changes in liquidity, sentiment, and investor risk appetite. So when Bitcoin starts to climb, especially after a rough period, it can often be a sign that broader markets are about to follow. Right now, Bitcoin is above its April 2nd level, which Tom takes as a bullish confirmation. He believes the asset's strength shows that investor confidence is quietly rebuilding, even if it's not fully reflected in the stock market yet. So if Bitcoin's moving first, the S&P may not be far behind. Now let's talk inflation, because that's still the elephant in the room. Tom made a strong case that inflation is weakening, not strengthening, despite what tariffs might imply. He backed it up with two main indicators. 1. Commodities, especially oil, which have not spiked aggressively, and 2. Labor data, particularly JOLTS, showing a cooling job market without major wage pressure. So if the data continues to support this narrative, we might actually see disinflation, which gives the Fed room to ease or at least hold rates steady. And here's where that connects back to markets. If inflation is under control and the Fed isn't tightening further, then risk assets, especially tech stocks and crypto, could be poised for another leg up. So here's my bottom line after watching that Tom Lee interview. 1. The market has already absorbed a ton of shocks and survived. Tariffs are just another chapter in a longer story of economic resilience. 2. Volatility is cooling off and high-yield credit is bouncing back. Those are early signals of stability, not stress. 3. Bitcoin is flashing a green light, not just for crypto bulls but for equity investors too. If you're ignoring that signal, you might be missing the bigger picture. 4. Inflation? Not the threat it was a year ago. Oil is behaving, jobs are cooling, and the Fed could be closer to a pivot than many realize. That's why Tom believes the S&P still has upside toward 5,800. And frankly, I agree. This could be one of those moments where sentiment is trailing reality. Now, as promised, after hearing all this from Tom Lee and breaking it down for you, I want to pivot to something more actionable, the best tech stock to buy right now. This is a stock that's already showing strong fundamentals, has room to run, and could massively benefit from exactly the kind of market shift Tom is talking about. If you're looking to position yourself ahead of the curve, stick around, because I'll walk you through exactly why I believe this high-growth tech stock is a must-watch for your portfolio right now. But before we jump into that, do me a favor. Smash the like button, let's hit that one. 000 like goal, drop your thoughts in the comments, and of course, subscribe so you don't miss the tech pick coming up next. Let's dive in. The company we've been talking about this whole time is none other than AMD, ticker symbol AMD. This company isn't just riding the wave of technological advancement, it's it. They're pushing the boundaries of what's possible, developing the brains behind the devices and systems shaping our world. From lightning-fast CPUs powering your laptops and gaming consoles to the high-performance GPUs driving groundbreaking graphics and AI, this company is everywhere. They're not just keeping up, they're setting the pace. Their commitment to research and development is unmatched, constantly pushing the envelope and delivering cutting-edge solutions. AMD is a company that doesn't just talk the talk, they walk the walk, delivering tangible results quarter after quarter, and the market recognizes their dominance. Analysts are giddy with price targets soaring. This isn't just hype, it's backed by solid performance and a vision for the future. They're a dominant force in the semiconductor industry, leading the charge in AI and data centers. Their financials are rock solid, with analysts projecting continued growth in revenue and earnings. And yes, they're facing headwinds, but they're tackling them head-on, demonstrating their resilience and adaptability. AMD isn't a company resting on its laurels. They're constantly innovating, pushing the boundaries of what's possible. And that's what makes them a compelling investment opportunity. Data is the new gold. In today's digital age, information is more valuable than ever before. Every click, every transaction, every piece of data holds immense potential. And AMD is sitting on a goldmine. They have amassed a treasure trove of data, making them a powerhouse in the industry. They're a titan in the data center market, with facilities that span across continents. Their infrastructure is unparalleled, designed to handle the massive influx of data generated every second. Providing the muscle behind the cloud, they ensure that our digital experiences are seamless and uninterrupted. From streaming services to online shopping, their servers are the backbone of our digital lives. Powering the servers that run our digital lives, they play a crucial role in keeping the internet running smoothly. Their technology is at the heart of everything we do online. And with the explosion of artificial intelligence, their dominance is only growing. AI is transforming industries, from healthcare to finance, and this company is at the forefront of this revolution. AI demands immense computing power, and this company is delivering. Their state-of-the-art facilities are equipped with the latest technology to support the ever-growing needs of AI applications. They are constantly innovating, ensuring that they stay ahead of the curve. Their commitment to excellence is evident in every aspect of their operations. They're the engine behind the AI revolution, fueling the algorithms that are changing the world. From self-driving cars to intelligent personal assistants, their technology is making the impossible possible. They are enabling breakthroughs that were once thought to be science fiction. Their contributions are shaping the future of technology. We're talking about major tech players, the giants of the industry, who rely on this company's products and services. Their client list reads like a who's who of the tech world. The giants of the industry from Silicon Valley to Wall Street are lining up to get their hands on AMD's products. The demand is insatiable and it shows no signs of slowing down. Their strategic vision and innovative approach have set them apart from the competition. The company's growth trajectory is impressive and the market is taking notice. Their financial performance is strong and their future prospects are even brighter. Investors are excited and for good reason. AMD currently boasts a market capitalization of $162.66 billion. Their earnings per share sit at $1.02 with a pretty steep price-to-earnings ratio of 98.62, which suggests that investors are paying a premium for growth. In terms of revenue, they pulled in $25.79 billion in 2024 and reported a net income of $1.64 billion. That gives them a profit margin of 7.71%, a noticeable jump from the previous 5.59%. Return on equity has also ticked up slightly to 2.85%, and the company continues to maintain an incredibly low debt-to-equity ratio of just 0.01, meaning AMD is operating with minimal leverage, a strong indicator of financial stability. Here's where it gets even more interesting. AMD's current stock price is around $100.59, but analysts estimate its fair value at about $188.57. That's a whopping 87.46% discount to fair value, suggesting the stock could be significantly undervalued. Some estimates even suggest a fair share price closer to $150, indicating a potential upside of over 50%. Combine that with the fact that AMD has only missed earnings per share expectations once in the last 12 quarters, and you start to see why investor confidence is high. Looking ahead, there's a lot of anticipation around the upcoming Q1 earnings report. Analysts are projecting strong revenue contributions from AMD's data center segment, which now accounts for nearly 49% of the company's total revenue. This growth is expected to help balance out softer performance in gaming and embedded segments. And with products like the MI300X and EPYC continuing to generate solid demand, the data center side of the business is expected to stay strong. Despite facing stiff competition from the likes of NVIDIA, AMD is holding its ground. Analysts remain bullish, with some even calling the stock a strong buy ahead of earnings, citing the company's resilient growth story and potential for price appreciation. However, not everything is smooth sailing. One concern on the horizon is the tightening of U.S. chip export restrictions to China. That geopolitical pressure has already led some analysts to lower their price targets for AMD, warning of possible headwinds in the near future. It's something to keep an eye on as trade policies evolve. That said, AMD continues to exhibit solid financial health, a lean capital structure, and a strong operational base. The company's active share buyback policy and its strategic foothold in high-performance computing make it a formidable player in the semiconductor space. So overall, AMD looks like it's in a solid position right now. It's undervalued relative to its intrinsic worth. It's riding high on optimism around its data center growth, and it has a proven track record of navigating challenging environments. While export restrictions could throw a wrench into future performance, the broader outlook remains positive, especially with earnings season just around the corner. Investors are watching closely, and for good reason. As we look to the future, one thing is clear. AMD will be at the heart of the AI revolution, driving progress and shaping the world of tomorrow. Now let's address the elephant in the room. We can't talk about AMD without mentioning the recent export restrictions. These restrictions have sent ripples through the industry, affecting not just AMD but many others in the sector. The global supply chain has been disrupted, and businesses are scrambling to find alternative solutions. Yes, they present a challenge, but are they insurmountable? The initial reaction might be one of concern, and rightly so. However, history has shown us that companies often emerge stronger from such adversities. It's a test of resilience and innovation. AMD is a fighter, and they're already adapting. They're not sitting idly by, waiting for the storm to pass. Instead, they're taking proactive steps to mitigate the impact of these restrictions. They're exploring new markets, diversifying their product lines, and finding innovative solutions to navigate these hurdles. By tapping into new regions and customer bases, they're spreading their risk and opening up new revenue streams. Remember, folks, every challenge is an opportunity. This isn't just a cliché, it's a fundamental truth in the business world. Challenges force companies to think outside the box and come up with creative solutions. AMD is using this situation to become even stronger, even more resilient. They're not just surviving, they're thriving. By turning obstacles into stepping stones, they're setting themselves up for long-term success. They're proving to the world that they're not just a one-trick pony, they're a force to be reckoned with. Their ability to pivot and adapt is a testament to their strong leadership and dedicated team. And let's not forget about market volatility. The stock market is inherently unpredictable, with ups and downs that can unsettle even the most seasoned investors. It's a fact of life in the stock market. But it's also where opportunities lie. Volatility can be a double-edged sword, but for those who know how to wield it, it can be incredibly rewarding. But savvy investors know that volatility creates opportunities. They understand that market fluctuations are a chance to buy undervalued stocks and benefit from future growth. It's a chance to buy low and ride the wave as the company overcomes these challenges. By staying informed and making strategic decisions, investors can turn market volatility to their advantage. In today's fast-paced world, the stock market can seem like a daunting place, filled with endless data and unpredictable trends. But fear not, because with the right knowledge and tools, you can navigate these waters with confidence. Let's talk about you, the investor. Are you ready to spot these opportunities to find the hidden gems before everyone else? Imagine being able to identify stocks that are undervalued, stocks that have the potential to grow exponentially. That's where our Value Stocks Investing Master Course comes in. This isn't just any course, it's a comprehensive guide designed to transform you into a savvy investor. This course will equip you with the knowledge and tools you need to succeed. You'll learn how to identify undervalued companies like the one we're discussing to separate the hype from the real deal. In a market flooded with information, it's crucial to know what to look for and what to ignore. We'll teach you how to analyze financial statements, understand market trends, and make informed investment decisions. No more second-guessing or relying on gut feelings. We'll show you how to use data and analysis to back your decisions. And make informed investment decisions. Imagine the confidence you'll gain, knowing that your investments are based on solid research and proven strategies. No more relying on gut feelings or following the crowd. You'll be able to make decisions that are right for you, based on your own analysis and understanding. This course will empower you to become a confident, successful investor. Don't miss out on this opportunity to take control of your financial future. With the right guidance and resources, you can achieve your investment goals and secure your financial well-being. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and join today at a 67% discount price. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. So what do you think? Are you bullish on AMD's future prospects? Do you believe they can overcome these challenges and continue their impressive upward trajectory? Let me know your thoughts in the comments below. I love hearing from you, the viewers. Your insights and perspectives are invaluable to us. And don't forget to hit that like button and subscribe to the channel for more market-moving analysis and investment opportunities. Until next time, keep investing wisely and stay informed.